So you want to invest, but you're scared to invest too much at once and then have the market go down. You've heard investing was risky. What if I told you a secret a friend told me? This summer, I was talking with an old man named Freddie. When I say old, he was older than me. He was old enough to have retired 3 times. He was so good at his job, people would pay him anything he wanted to design and build large offices and parking decks. So he kept leaving retired life and going back to work. Now, he wasn't so old that he drove a Buick. He had a brand new Corvette. I saw it in his garage. His wife drove the Buick. It was summertime, and Freddie and I were talking about cars and his latest building project. He was excited about retiring. Well, for the 4th time. He wanted to take the grandkids traveling. I guess they would have to take the Buick. So, Freddie gave me some advice that hot summer day. I'm not the only one he told. He has a daughter named Lillian. He loves her very much. Freddie guides Lillian towards the same investment strategy I'm going to share with you. You have to understand a few things about Freddie. Freddie doesn't drink, he doesn't gamble, doesn't smoke or vape, and he doesn't take risk. He's been a risk avoider his whole life. He doesn't get into investments or deals where he's going to lose money. Now, something about me. I've been investing since I was 8 years old. When I was just a kid, I earned money at a job and I invested it with my father's help. I would choose the investment and my dad would put my savings into it. Over the years, I've gotten pretty good. Good enough to have 4 books published on the subject. But the investment strategy Freddie told me, sitting outside in the heat, I had never heard before. Sure, we know the idea of buy low and sell high, but Freddie added simplicity and numbers to this investment strategy. And he never lost money. Once hearing it, I started calling it the 5 at 5 investment strategy. I thought that sounded better than Freddie's concept. Freddie's investment advice was to save up in a savings account and wait for the stock market to drop 5% compared to the previous month. When the stock market would drop, he would buy $5,000 in an index fund. He would never invest more than $5,000 at a time. If the stock market continued to drop an additional 5% the next week or month, he would invest another $5,000. He would never risk more than $5,000 at a time. If the stock continued to go down, his loss would be limited. When it went back up, he would profit. Freddie only bought index funds when they were on sale. Sure enough, the value came back. Sure enough, Freddie made money. Now, like I said, Freddie was old and he kept working most of this time. He had no need to pull money out of the stock market. In fact, he kept putting money in his entire working life. When I was talking with him, he had just bought an index fund that buys data processing centers called Digital Retail Trust, DLR for short. In 8 months, he was already up over 22%. And that's an annual percentage rate increase of over 38%. Now, I'm not too shy, so I asked him which other index funds he owned. He started to rattle them off. Now, I wasn't so bold to ask him how much he made. I went home to figure that out. If he just did this one time in 2009, well, you can see the figures that were possible. The Dow Jones is a popular index. If Freddie invested $5,000 every month the index dropped 5% or more since May of 2010, he would have put in $55,000 and have over $115,950 to show for it. Freddie told me the first index he invested into was the S&P 500, and he started in May of 2010. He didn't brag about how much he had, but I pulled up the historical data to find out how many times he would have invested and approximately how much he'd have. Between then and July 2021, the market dropped 5% or more from the previous month 12 times. At $5,000 each investment, he would have put in $60,000 and have over $135,700. I was amazed at the possible return, so I kept doing some math. If he invested in the NASDAQ index from May 2010 through July 2021, using only $5,000 each month that dropped 5% or more, he would have over $273,000, but only put in $70,000 total. I asked Freddie if I could share his formula, and he said sure. I also asked if he had any other advice. He told me that this method used the best part of dollar cost averaging. You see, dollar cost averaging is putting in the same dollar amount month after month, regardless of the price of the index fund. You buy more shares when the price is low and fewer shares when the price is high. Freddie just eliminated the part of buying fewer shares when the price is high. He only bought the more shares when the price was low. Freddie also said that the dollar amount doesn't have to be $5,000. It would be anything you have saved up. Young people may not be able to save up $5,000 to be able to invest when the stock market drops 5%. If the market drops 5%, put in what you have. Then save up for the next drop. It might take 6 months or a year for the next 5% drop. And in that time, you save. But don't risk more than $5,000 at a time per index fund. If you look at the history, stocks have dropped 5% in a month and then continue to fall. As you continue to invest as the index fund goes down, you reduce your average cost of the shares. When the price goes back up, you win. Freddie continued with his advice. He said, young people don't live on the cheap. When he first came here from Mexico as a teenager, he knew he could live cheaper than other teens in his school. So that's what he did. He worked and saved. He spent money when he felt it was important, not when his friends told him to spend. He said his friends wanted to go out to eat, but Freddie's mom made great empanadas, so he would fill up at home and go out with his buds and only get a small something instead of an expensive meal. As an adult, if he wanted something extra, something nice, something for himself, he would work a second job to earn the money. He would never take money away from his regular income that was designated for his family. His Corvettes, yes, multiple vets, were all paid for from side gigs. Remember what I said earlier about Freddie? He doesn't drink, gamble, smoke, or vape, and he doesn't take risk. He saves up $5,000 at a time and invests when the stock market drops 5% or more from month to month. He follows the 5 at 5 investment strategy.